Reformation Inc. Pre-IPO Institutional Research Report. Section 1. Executive Summary. Reformation Inc. is a Los Angeles-founded, sustainability-focused women's apparel brand that has filed to go public on the New York Stock Exchange under the ticker REF. As of this report's date, the company is not yet publicly traded. Its IPO is expected to price on July 29, 2026, with trading to begin the following day, July 30, 2026, subject to market conditions. In plain terms, Reformation sells dresses, denim, and other women's clothing, primarily through its own website and roughly 70 branded retail stores, built around a sustainability story that has resonated with a loyal, largely millennial and Gen Z customer base since the brand's 2009 founding. Unlike most young apparel brands, Reformation has already scaled to real size. $507.1 million of net revenue in fiscal 2025, up 15.7% year-over-year, with sales in the most recent quarter growing an even fastest 30.4%, extending a streak of 20 consecutive quarters of double-digit growth. The company is also, by industry standards, unusually direct-to-consumer heavy. Roughly 90% of 2025 revenue came from its own website and stores, rather than wholesale partners like Nordstrom. The IPO itself is a mix of new capital for the company and a partial exit for existing owners. Of the 14,062,500 shares being offered, only 9,478,821 are newly issued shares, raising money for Reformation itself, while the remaining 4,583,679 shares are being sold by existing stockholders, most notably private equity firm Permira, which has controlled Reformation since acquiring a majority stake in 2019. At the top of the proposed price range, Reformation would carry a total equity value of approximately $1 billion. Key facts. Business. Sustainability-positioned women's apparel, sold DTC, approximately 90% of revenue, and wholesale. Store footprint. Approximately 70 physical retail stores, up from 49 in early 2025. FY 2025 net revenue, $507.1 million, up 15.7% year-over-year. FY 2025 net income, $12.6 million, down from $32.6 million in FY 2024. Q1 2026 revenue, $112.3 million, up 30.4% year-over-year. Q1 2026 result, net loss, despite a one-time tariff refund boost to gross margin. Controlling shareholder, Permira, private equity, majority owner since 2019. Section 2. Investment Thesis. The bull case for Reformation is that it has done something genuinely rare in apparel retail. Built a real $500 million+ revenue brand almost entirely through direct digital and owned store relationships with customers, rather than depending on wholesale partners or heavy discounting, while maintaining a differentiated sustainability positioning that continues to resonate as consumer interest in environmentally conscious brands grows. 20 consecutive quarters of double-digit revenue growth, accelerating to 30.4% in the most recent quarter, is a genuinely strong operating track record heading into an IPO. The bear case centers on profitability and deal structure. Net income actually declined in fiscal 2025, even as revenue grew, and the company posted a net loss in the first quarter of 2026, despite a one-time tariff refund that artificially inflated the headline gross margin figure. Layer on top of that a deal where nearly a third of the shares being sold are secondary shares benefiting existing owners, rather than raising growth capital for the company. And investors are being asked to pay up to a roughly $1 billion valuation for a business whose underlying profitability trend, once one-time items are stripped out, is genuinely uncertain. Thesis in one sentence. Reformation offers real revenue scale and a differentiated sustainable fashion brand with a loyal customer base. but investors are paying a consumer brand valuation for a company whose recent profitability has been declining, and whose most recent margin improvement was substantially a one-time accounting benefit, not a durable trend. Section 3. Company Overview. Legal entity, Reformation Inc. Headquarters, Vernon and Los Angeles, California. Exchange and ticker, NYSE, REF, expected. Year founded, 2009, by Yael Aflalo in Los Angeles. Chief Executive Officer, Holly Borenstein, since 2020. Controlling shareholder, Permira, majority owner since 2019. Active DTC customers, approximately 1.14 million as of March 28, 2026. Store count, approximately 70 physical retail locations. Corporate milestones. In 2009, Yael Aflalo founded Reformation as a small vintage clothing shop in Los Angeles, bootstrapped with roughly $7,000. In 2013, Reformation opened its own Los Angeles apparel factory, described as one of the first sustainably focused apparel factories in the United States. The company also began selling online that year. In 2017, a $25 million Series B financing led by Stripes Group funded digital scaling. In July 2019, Permira acquired a majority stake in Reformation. In 2020, Aflalo stepped down as CEO following employee allegations regarding workplace culture. Holly Borenstein, previously president, became CEO. In 2023, Reformation explored a potential IPO as revenue surpassed $300 million, but ultimately did not proceed. In 2025, full-year net revenue reached $507.1 million, up 15.7% year-over-year. On July 3, 2026, the company publicly filed Form S-1 with the SEC. On July 20, 2026, it launched its roadshow and set terms, 14,062,500 shares at $15 to $17 per share. On July 29 to 30th, 2026, the IPO pricing and NYSE trading debut are anticipated. Section 4. Business Model. Reformation designs, manufactures in part, and sells women's apparel and accessories, generating revenue predominantly through direct-to-consumer channels, its own e-commerce website, and roughly 70 branded retail stores, which together made up approximately 90% of fiscal 2025 revenue, $454.06 million of the $507.10 million total. The remaining revenue comes from wholesale relationships with third-party retailers such as Nordstrom. This DTC-heavy mix is unusual for an apparel company of Reformation's scale, and is central to the company's investment pitch. By controlling the customer relationship directly, Reformation captures more of the retail margin than a brand that relies primarily on wholesale distribution, and can gather first-party data on customer behavior to inform merchandising and marketing decisions. A key strategic emphasis is omni-channel behavior. Customers who shop both online and in physical stores purchase an average of 4.8 times per year and generate 3.1 times higher annual net spend compared with customers who shop through only one channel. This is why Reformation has continued investing in its physical store footprint, growing from 49 stores in early 2025 to roughly 70 more recently, even in an era when many retailers have pulled back on brick and mortar. Management views stores less as a separate sales channel and more as a way to deepen engagement with customers who ultimately spend more across the full relationship. Section 5. Products and Services. Reformation's core product assortment centers on women's dresses and denim, extending into broader ready-to-wear categories alongside accessories. The brand's central differentiator versus most apparel competitors is sustainability, positioned not as a marketing add-on, but as an operating principle. The company has been carbon neutral since 2015, manufactures more than half of its products in its own Los Angeles factory, uses dead stock and eco-conscious fabrics, and publishes a proprietary RefScale sustainability metric tracking the environmental footprint of individual products, alongside quarterly sustainability reporting. Revenue channels, e-commerce through the Reformation.com, included in the $454.06 million DTC total, with more than 120 million website visits in 2025. Primary customer acquisition channel, retail stores, also included in the DTC total. Approximately 70 branded stores, used strategically to deepen customer engagement and drive higher omnichannel spend. Wholesale, $53.04 million, through third-party retail partners, including Nordstrom. Reformation has also signaled ambitions to expand into new product categories and additional international markets. The UK, Europe, and Asia have been cited, beyond its current predominantly U.S.-focused footprint, building on its existing base of more than 1 million active DTC customers. Section 6. Industry Overview. Reformation competes in the highly fragmented U.S. women's apparel market, within a specific subsegment of digitally native, direct-to-consumer fashion brands. This category has produced a mix of outcomes for investors. Some DTC apparel and footwear brands, Allbirds for instance, have struggled significantly as public companies after early hype, while others have built durable, profitable businesses. Reformation's IPO is widely described as a test case for whether sustainability can function as a durable, monetizable differentiator in a crowded apparel market, rather than simply a marketing narrative. The apparel industry more broadly has faced a volatile trade policy backdrop, with tariffs imposed under the International Emergency Economic Powers Act, materially raising the cost of imported goods for import-dependent retailers throughout 2025. Reformation's own disclosed 360 basis point gross margin hit from IEEPA tariffs in fiscal 2025 illustrates this exposure directly. More recently, legal challenges to the IEEPA tariffs' constitutionality have led to a wave of refunds to affected importers, a dynamic that directly boosted Reformation's most recent quarterly gross margin, though the longer-term trade policy environment remains unsettled. Section 7. Market Opportunity. Reformation's near-term growth opportunity spans three distinct levers: continued store network expansion, from 49 stores in early 2025 towards 70 and beyond; international expansion into the UK, Europe, and Asia, where the brand currently has limited penetration; and continued e-commerce growth, supported by more than 120 million annual website visits and a base of over 1 million active DTC customers. Longer term, management and Permira have also pointed to new product category expansion as a growth avenue, extending the Reformation brand and sustainability positioning beyond its current core of dresses and denim into adjacent categories. Reformation's growth algorithm is fairly conventional for a scaling DTC retailer: more stores, more countries, more categories, more customers, which is a strength in that it's a proven playbook, but also means the company's growth is not protected by any structural moat beyond brand loyalty and its sustainability positioning, both of which require continued investment and consistent execution to maintain. Section 8. Competitive Landscape. Competitors include Everlane, Pact, and Quince, private DTC apparel brands with directly comparable sustainability or value positioning; Revolve Group, public on NYSE, a digitally native women's fashion retailer with a successful IPO track record; Allbirds, public on NASDAQ, a sustainability-positioned DTC brand whose post-IPO stock performance has been weak, serving as a cautionary comparable for the sustainability premium thesis; department store and wholesale channels such as Nordstrom, both a distribution partner and a competing shopping destination; fast fashion retailers competing for the same customer's attention and wallet with a fundamentally different, lower price, higher volume, faster cycle value proposition. CEO Holly Borenstein has publicly framed Reformation's competitive resilience around two pillars: product and brand, arguing that despite a growing number of brands targeting a similar sustainability-conscious customer, Reformation's combination of design execution and consistent brand storytelling has kept its customer base engaged. The company's revenue scale of over $500 million and consistent double-digit growth support this claim. That said, Allbirds' post-IPO struggles serve as a clear reminder that public markets have not uniformly rewarded sustainability positioning on its own. Section 9. Management Team. Hallie Borenstein, Chief Executive Officer since 2020, joined Reformation as Director of Merchandising roughly 11 years ago after a career at Bain & Company. Rose to President before being named CEO in 2020, when Aflalo stepped down following employee allegations regarding workplace culture. Under her leadership, Reformation has grown from roughly $300 to $350 million of revenue to more than $500 million, expanded its store count from just 3 locations when she joined merchandising to roughly 70 today. Yael Aflalo, founder, no longer in an operational management role, founded Reformation in 2009, bootstrapping the business with roughly $7,000. Sold majority control to Permira in 2019, while remaining a significant owner and CEO, stepped down as CEO in 2020, retains a minority equity stake, and launched a new eponymous fashion label in September 2024. Governance and ownership. Permira, the London-headquartered global private equity firm, has held majority control of Reformation since 2019 and is expected to retain substantial influence following the IPO. Permira's prior experience includes backing Hugo Boss, Valentino, and Dr. Martens. Section 10. Financial Performance. Net revenue, FY 2024, $438.2 million. FY 2025, $507.1 million, up 15.7%. Net income, FY 2024, $32.6 million. FY 2025, $12.6 million. Adjusted EBITDA, FY 2025, $45 million, representing an 8.9% margin. Gross margin, FY 2024, 64% or higher. FY 2025, 60.2%, down 360 basis points due to IEEPA tariff impact. In plain terms, Reformation's top line kept growing at a healthy double-digit pace in 2025, but its bottom line moved the wrong way. Net income fell by more than 60%, from $32.6 million to $12.6 million, even as revenue grew. The company attributes part of this squeeze directly to tariff costs. This is an important data point for investors to internalize. Reformation's historical profitability was better than what it delivered in its most recent full fiscal year, and a meaningful part of that gap was driven by an external trade policy shock rather than deteriorating brand demand. Capital structure. Reformation has been majority-owned by private equity firm Permira since 2019. Use of IPO proceeds is expected to include debt reduction and the repurchase of shares held by certain existing investors, alongside general corporate purposes. Section 11. Detailed Analysis. Latest Quarterly Financials. Q1 2026. Revenue. Net revenue was $112.3 million, up 30.4% year-over-year, the 20th consecutive quarter of double-digit growth, and a meaningful acceleration versus the 15.7% full-year 2025 growth rate. This is a genuinely strong top-line result by any standard. Gross margin was 70.3%, up roughly 1,000 basis points from 60.3% in the year-ago quarter. However, investors need to understand this figure carefully. Approximately 900 of those 1,000 basis points came from a one-time refund of IEEPA tariffs, not from an underlying, repeatable improvement in the business. Strip out the refund, and the remaining underlying improvement, roughly 100 basis points, driven by strong full-price selling, is far more modest and far more representative of what investors should expect going forward. Operating income and net income. Despite the large tariff refund benefit, Reformation still reported a net loss for the quarter, approximately $12.1 to $12.4 million, underscoring that operating expenses grew fast enough to offset even this unusually favorable gross margin quarter. Guidance. As a pre-IPO company, Reformation has not issued formal forward guidance. CEO Hallie Borenstein has previously stated the business was on track to comfortably exceed $500 million in annual sales, which it has now done, with EBITDA margins in the high teens % range referenced in prior public commentary. Though the FY 2025 adjusted EBITDA margin of 8.9% disclosed in the S1 appears lower than that previously referenced figure. Section 12. Growth drivers. First, continued store network expansion. Growth from 49 stores in early 2025 to roughly 70 today, with each new store shown to meaningfully lift customer spend through the omni-channel effect, 4.8 times purchase frequency and 3.1 times higher annual spend for dual-channel shoppers. Second, international expansion. Entry into and growth across UK, European, and Asian markets represents a substantial greenfield opportunity relative to Reformation's current predominantly U.S. revenue base. Third, wholesale channel growth. Continued expansion of wholesale partnerships, such as with Nordstrom, offers an incremental distribution channel, even as DTC remains the strategic priority. Fourth, full-price selling discipline. Management has specifically cited strong full-price sales growth as a genuine, non-tariff-related driver of margin improvement, a healthy sign of brand pricing power. Fifth, new product category expansion. Both management and Permira have signaled ambitions to extend the Reformation brand into new product categories beyond its current core of dresses and denim. Section 13. Key risks. Risk 1. Declining underlying profitability. FY 2025 net income fell more than 60% year-over-year, despite double-digit revenue growth, and the company posted a net loss in Q1 2026, even with a large one-time tariff refund benefit, suggesting underlying cost pressures are outpacing revenue growth. Risk 2. Non-recurring margin boost inflates recent results. Roughly 900 of the 1,000 basis points of Q1 2026 gross margin improvement came from a one-time IEEPA tariff refund. Investors extrapolating the headline 70.3% gross margin figure forward would be making a significant analytical error. Risk 3. Large secondary component and insider selling. Of the 14,062,500 shares in the offering, only 9,478,821 are primary shares raising capital for the company. The remaining shares are being sold by existing stockholders, chiefly Permira, meaning a meaningful portion of the deal provides liquidity to insiders rather than growth capital to the business. Risk 4. Continued private equity control. Permira is expected to retain majority or dominant influence over the company post-IPO, limiting public shareholders' influence over major corporate decisions. Risk 5. Trade policy and tariff uncertainty. While the IEEPA tariff refund benefited the most recent quarter, broader U.S. trade policy remains unsettled, with alternative tariff mechanisms potentially reintroducing similar cost pressures. Risk 6. Crowded, competitive apparel market. Reformation competes against both other sustainability-positioned DTC brands and low-cost fast fashion retailers in a category where brand loyalty can shift quickly. Public market comparables such as Allbirds illustrate that sustainability positioning alone has not guaranteed strong post-IPO stock performance. Risk 7. Past governance and culture controversy. Founder Yala Flalo resigned as CEO in 2020, following employee allegations regarding workplace culture. While current leadership has been in place for over 5 years, this remains part of the brand's public record. Risk 8. Consumer discretionary spending sensitivity. As a premium-priced apparel brand, Reformation's sales are inherently exposed to broader consumer discretionary spending cycles and shifts in fashion trends. Risk 9. IPO not yet priced. As of this report's date, Reformation's IPO has not yet priced. Final offering price, proceeds, and trading debut timing remain subject to change. Section 14. Valuation. Proposed price range, $15 to $17 per share. Total shares in the offering, 14,062,500, consisting of 9,478,821 primary and 4,583,679 secondary shares. Over-allotment option, up to 2,109,375 additional shares from selling stockholders. Expected gross proceeds, approximately $211 million at the low end to approximately $239 million at the high end. Implied total equity value, approximately $945 million at the $16 midpoint, up to approximately $1 billion at the top of the range. FY 2025 net revenue, $507.1 million. FY 2025 net income, $12.6 million. At the midpoint of its range, Reformation would be valued at roughly 1.9 times FY 2025 net revenue. A reasonable, if unspectacular, multiple for a mid-single-digit margin apparel retailer, though one that leaves relatively little room for error given the company's declining net income trend. Much of the investment case rests on continued strong revenue growth translating into meaningfully improved profitability over time, rather than on the company's current earnings power alone. Section 15. Upcoming catalysts. IPO pricing, expected July 29, 2026, will set the final valuation and gauge real investor demand for the offering. NYSE trading debut, expected July 30, 2026. First public market test of the stock's trading behavior and investor reception. First post-IPO quarterly earnings report will show whether the underlying non-tariff boosted margin and profitability trend is improving or continuing to deteriorate. Holiday and Q4 2026 selling season, a seasonally significant period for apparel retailers, and an important early test of demand as a public company. Store network and international expansion updates. Continued execution against the stated growth playbook. More stores, new geographies, is central to the long-term growth thesis. Further clarity on IEEPA tariff and trade policy environment will determine whether the tariff cost pressure seen in FY 2025 fully reverses, partially persists, or is replaced by alternative tariff mechanisms. Section 16. Long-term outlook. Reformation's long-term outlook hinges on whether the company can convert its proven revenue growth engine, 20 consecutive quarters of double-digit growth, into durable, expanding profitability as a public company, rather than the declining net income trend seen in fiscal 2025. If store expansion, international growth, and full-price selling discipline continue delivering the kind of margin gains management has pointed to, Reformation could plausibly grow into a materially higher earnings base over the next several years, supporting its roughly $1 billion IPO valuation and beyond. If instead, rising operating costs continue outpacing revenue growth as they did in the most recent quarter, the company could face a difficult reset in investor expectations, regardless of how strong its top-line growth remains. The broader long-term opportunity, a scaled, profitable, sustainability-differentiated apparel brand with genuine international white space, remains a credible one, supported by real operating results. But Reformation's own numbers suggest the path from $500 million revenue brand to durably profitable public company is not yet fully proven. Section 17. Bull Case. Reformation's 30.4% Q1 2026 revenue growth proves sustainable, rather than a one-quarter anomaly. Store network expansion into new U.S. and international markets continues delivering the strong omnichannel spend multipliers management has highlighted. Full-price selling discipline and operating leverage from the public company cost base drive genuine underlying margin expansion over the following several quarters. International expansion into the UK, Europe, and Asia opens meaningful new revenue pools, and the broader consumer shift towards sustainability-conscious brands continues to favor Reformation's positioning. In this scenario, Reformation converts its proven revenue growth engine into expanding profitability, and the stock re-rates above its IPO valuation as the market gains confidence in a durable, profitable growth story. Section 18. Bear Case. Once the one-time IEEPA tariff refund benefit rolls off, Reformation's true underlying gross margin proves structurally lower than the headline Q1 2026 figure suggested, and net losses persist or widen as the company continues investing heavily in stores, marketing, and public company overhead. Revenue growth decelerates from the unusually strong 30.4% pace back toward the more moderate 15.7% FY 2025 rate, or lower, as the law of large numbers catches up with the business. Renewed tariff cost pressure emerges through alternative trade policy mechanisms. Competition from both other sustainability-branded DTC players and fast fashion continues intensifying, and Permira's continued large ownership stake and eventual further share sales create a persistent overhang on the stock. In this scenario, REF shares could underperform, echoing the disappointing post-IPO trajectory of other sustainability-branded consumer names like Allbirds. Section 19. Final Investment Conclusion. Reformation arrives at its IPO with a genuinely proven revenue story. More than $500 million of annual sales, 20 consecutive quarters of double-digit growth, a loyal and growing customer base, and a differentiated sustainability brand position that has survived more than 15 years, and one high-profile leadership transition. That combination of scale and brand durability is not something every consumer brand IPO candidate can claim. At the same time, the company's own disclosed numbers tell a more complicated profitability story than the headline growth figures suggest. Net income declined sharply in fiscal 2025. The company posted a net loss in its most recent quarter, despite an unusually favorable one-time tariff refund. And nearly a third of the IPO shares are secondary shares benefiting existing owners, rather than raising growth capital. Investors should focus less on the eye-catching 70.3% Q1 2026 gross margin figure, and more on the underlying tariff refund-adjusted trend, when assessing whether Reformation's roughly $1 billion valuation is fully supported by its current earnings power. Bottom line, Reformation offers real, differentiated revenue scale in sustainable fashion, but investors should treat the recent margin and profitability picture with caution given the significant one-time items involved, and should weigh the meaningful secondary share component of the offering when assessing how much of the deal represents genuine growth capital versus insider liquidity. This report does not constitute a recommendation to buy, sell, or hold REF shares. Readers should review the complete Form S-1 on SEC EDGAR and consult a qualified financial advisor before making any investment decision. End of report.